Let's start with interest rates. What's the right way of looking at what the ECB should do from now until the summer and then beyond?
Let me first explain perhaps briefly where we are in the European economy. Activity is more resilient than expected, and we should avoid recession this year, probably. And second, inflation will very probably peak in this semester, first on headline and then on core. But we must stay the course in our battle against inflation. I'm very clear about that. We will win this battle. Let me be extremely straightforward, Francine. We will bring inflation back towards 2% by the end of 24 or 25. But coming to our monetary policy, it means that if I look at what we did last year, let me say it was something like a sprint towards normalization, and we reached very fast the neutral rate at around 2%. This year, it's more about a middle distance run, and where we will have to combine two elements: the level of rates, which is your question, and the length of time we will stay there afterwards. Please.
No, Governor, so you believe basically we should reach the terminal rate by the summer and then hold. Is there a worry that if you go interest rates up too high after the summer that you overshoot it?
I don't think so. I cannot yet say where the terminal rate will be, but I think we should be there by summer. To put it in a nutshell, last year was about speed, the sprint. This year is more about a combination of level and duration. And it's very important also to say that afterwards we will stay at this terminal rate as long as necessary to bring inflation back towards 2%.
Governor, yesterday we had a story by Bloomberg, a Bloomberg scoop, saying that some people in the Governing Council believe that there should be a 50 basis points rise in February and then down to 25. Is this the right way of looking at it?
I saw this story. Frankly, Francine, I was quite surprised. We said very clearly we will decide meeting by meeting. We are data-driven, so it's much too early to speculate about what we will do in March. Let me remind you of the words of President Lagarde at her last press conference in December. We should expect to raise rates at a pace of 50 basis points for a period of time. Well, these words are still valid today. But again, we are pragmatic.
But Governor, given what we know today and what you've explained beautifully, do you believe the increase of interest rates will be slower from now until the summer than it was in 2022?
It was already the case in December. We were at 50, while at the two previous meetings we were at 75. But again, don't speculate about the pace, which probably is less important this year. We will go as high as necessary to bring inflation back towards 2%. We will stay our course on monetary policy. I am very clear on that.
Are you worried that you hike too much or hike too little at this point?
I think we are accurate. It's why we decide meeting by meeting. And we are data-driven. We will see exactly what happens on inflation, especially on underlying inflation. And I am always a bit cautious about this alleged opposition between hawks and doves. I am not a bird, I am a pragmatic, so I am data-driven, and I think this is the case for the vast majority of the Governing Council, starting with Christine Lagarde.
So, Governor, is your message today actually it's inappropriate to commit to 50 basis point hikes at the beginning of the year, given we don't know?
No, it's not my message.
How
you will see in February. But perhaps, let me say it this way. We shouldn't focus too much about if we would do 75, 50. It was a bit ridiculous last fall, remember, or 25. We should focus on our aim, stay our course, and we will go to the necessary terminal rate, as said, by summer.
So
and we are, let me be clear, we are not yet there today.
No. So, Governor, why do you think it was a bit ridiculous? Because you're guiding the markets? Or you have
because
too much pressure from the markets?
To focus exactly on what will be the pace at the next meeting. And remember, there were many expressions. I tried not to play this game. We don't give a forward guidance. but we should give a destination on inflation. This is why I am extremely clear about our commitment to bring inflation back towards 2%. It's not only a forecast, it's a commitment. And this is very important for inflation expectations. And I think that the question of the terminal rate by summer is still more important.
What are markets you think misunderstanding?
And perhaps last element,
yeah.
This element of duration, length of time at which we stay at terminal rate is also an important component of the efficiency of our monetary policy.
But so, I mean, it's the markets interpret in the fact that if you stay at these kind of levels for a longer time, then you have to hike less. Is that a fair assumption?
I cannot speak of a trade-off or an arbitrage, but we have two elements which we have to combine: as said, level and duration. So this second part of the game, after the sprint of last year, is somewhat more sophisticated, but we have more tools, including, if I may, QT, because we decided to start the reduction of our balance sheet.
What is the biggest actually unknown for inflation right now? Is it the China reopening and what that means for underlying inflation?
We have also domestic factors. Underlying inflation is the key story, as you just said. We will have good news on headline inflation because energy prices and raw material prices are going down. This is good news, which explains why we had first sign of reduction at the end of last year. But underlying inflation is determined also by the evolution of wages, by services. Yes, China could play a role on the global scene, but I would say that in the short run, domestic factors are probably the most important. By the way, we see in France and in other European economies an increase of wages, but we don't see so far a price-wages spiral. But yes, we remain very cautious on that. And our commitment to stay our course on monetary policy is probably part of this rather reasonable evolutions because it anchors inflation expectations not only by markets but by households and firms.
So the jobs markets in Europe has been holding quite strong, which is really quite incredible given the shocks that we've had. Is that what surprised you the most, and do you worry about the housing market?
No, the job market surprised us positively,
yes,
and on both sides of the Atlantic, clearly. There are probably explanations due also to the fact that it's very difficult for firms to hire, so they are very cautious to keep their people, even when the activity is slowing down, as we see presently. It means, which is good news, that we won't have probably a major increase in unemployment in most European economies.